Hello and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice. Hey, David, how's it going?
Hey, good, thanks. How you doing?
Good. We've got an exciting episode today. I'm really pumped about this one. We've been talking a lot in recent podcasts about having a good team, and so this is kind of an extension of that.
Yeah, we've talked with an insurance agent recently, you as a realtor recently. We've talked about how to work with contractors. We've talked about a lot of these different team members. But I know one that we haven't talked as much about is that tax professional or CPA and how the tax planning side comes into this. Not just the making sure you do the taxes right when April comes around, but that you're planning intentionally on the tax side to have a little bit of strategy there. I know I picked up a copy of Amanda Han and Matt MacFarland's book on tax strategies for the savvy real estate investor a few years ago. And I assumed it'd be this boring book on taxes. It's kind of like most people probably think a lot of pharmacy books are boring, right? And then we get into it. But this is one where I assumed it would be boring, but it was one that I read straight through in one night because it was written in a way that was just full of stories and examples. And that really helped me to understand a lot of big picture things about tax strategy, not remotely that I became a CPA overnight or anything, but it got me at least conversational about some of these topics so that I could talk with my CPA and ask questions and have more intelligent contribution to a little bit of this strategy discussion.
Yeah, and I think it's something that many investors may not think about, especially first-time investors may not think about up front because it seems like, well, it's just one property, it's just two properties. This isn't that big of a deal, but it really can be, and it can really make or break the difference between a good investment and maybe an okay investment. And so having that strategy up front, knowing how to understand things like depreciation, when to buy or sell, how to avoid or delay taxes, what kind of record keeping you need to do. Again, things that might sound uninteresting, but become super, super important part of the process. And you can, really set yourself up for success by doing this the right way up front.
Yeah. And just like the tax book was not boring, I love that the interview, you'd think that an interview with people talking about, I didn't think it was boring either. Like we talked about a lot of different things. We talked about a lot of tax strategy and there were examples and things that came up in here as well that I just loved the conversation that we got to have with them.
Yeah, Amanda and Matt were fantastic. And if you've not heard them before or aren't familiar with them, Matt and Amanda have actually been featured on a lot of different talks in the past. Again, their book, Tax Strategies for the Savvy Real Estate Investor, is available on Amazon or pretty much anywhere you get podcasts, or wherever you get books. They've been featured on Money Magazine, Talks at Google. They were on CNBC's Smart Money Talk Radio. They've been on Bigger Pockets podcast, which is where I had heard of them previously. They're incredible individuals. The other really neat thing they do is that they actually started a foundation called Animals for Armed Forces. They're a nonprofit. They actually help place over 1,500 shelter pets with forever homes, to veterans and things like that. And so it's a pretty incredible story. Their book, their website, everything. It's worth checking out.
Yeah, and they obviously have a grasp on a wide variety of real estate topics. We've heard questions come in and we've had guests in all kinds of different areas of real estate, from larger multifamily to short-term rentals. And so talking about all of that, we kind of jumped around to a lot of different topics. We tried to throw a lot of things at them to maximize the amount of content in there. So there's a lot of different things that'll come up, anything from cost segregation to how you strategically may write off part of a vacation, or all the record keeping, bookkeeping, software, when to engage with the CPA, so many different topics. So hang on tight. We cover a lot of ground in a short period of time.
Yeah, poor Amanda and Matt, they didn't know that if we got them on the show, we would just ask them all of our questions rather than trying to streamline it. But yeah, definitely for those that are familiar with the basics, perhaps, this is a really nice kind of level up, right? You're going to have some refresher of some of those basics, but also some thoughts about the future. I know there were things that we talked about that I had not considered in the past, or that I was maybe not doing in the most efficient way possible. So really excited to have them on the show and cover so many different areas.
Yeah, even just little examples of strategy that they throw out there. Like I know we've had on a recent webinar and other conversation, other things on the Facebook group about people that are jumping in by moving out of their home and converting their prior home to a rental property. And they shared some examples about the nuance there of if you live in a property for how long, what that means for capital gains, and you go to sell it, and the strategy of when to sell a property. And I mean, so much that I think, Nate, to your point of even if you have no real estate investing or you're just getting started, like there's so much intentionality that can come even right out of the gates from a tax standpoint. And so hopefully some of the stories and some of the content that they covered today can help share that same thought.
Yeah, absolutely. So definitely look for stories like that, because I think it's just an overall great episode with a lot of examples. So hope you guys enjoy. And again, thanks to Amanda and Matt for coming on the show. Just an excellent interview with them. So here you go. Hey, Matt, Amanda, welcome to the show.
Thanks, guys. Thanks for having us. Appreciate it.
Good to be here.
Yeah, we really appreciate it. We're big fans of the book. We heard a lot about you guys from other podcasts, and we just knew you'd be the perfect people to bring on to talk all things taxes. So we really appreciate your time this afternoon.
Yeah, thanks so much.
So why don't we start off, maybe just give us a kind of a big picture overview of some of the tax related advantages that someone might obtain through real estate. I think we hear a lot of things. There's a lot of myth and rumor and things floating around, but give us that big picture overview of what people might get as an advantage from the tax perspective.
Yeah, I mean, there's so many. There's so many benefits to real estate investing. I think, big picture perspective, most people hear, when it comes to taxes, you always hear about when they say, oh, if you're a business owner, you get to have a lot of tax write-off and tax deductions, right? The tax code is skewed towards business owners. And one of the main themes to understand is, as a real estate investor, you're not just an investor, but you're also a business owner as well. And what that means is, first and foremost, a lot of these quote unquote business expenses that are available to, maybe someone who owns like a franchise or something, or a medical practice or a pharmaceutical practice, those expenses generally are also eligible for real estate investors as well. And, this is true. I'm sure we'll talk more in depth later on today, but this is true regardless of whether you are an investor who has an LLC or a corporation or not. So simply being in the business of real estate investing does provide you the ability to take certain tax write-offs that maybe you otherwise might not be able to if your only other income is, from a source like a W-2.
Yeah. Yeah. I think for, the one thing that comes to my mind is just, I guess a good way to look at it might be to compare rental real estate investing to, I don't know, investing in the stock market or stocks, bonds, and mutual funds, right? Well, in both of them, the goal is to make income, right? When, stocks, bonds, mutual funds, you're making dividends, interest, capital gains. With the rental real estate, your goal is to have positive cash flow. So the main difference, I think, from a tax perspective is that with rental real estate, you get to use depreciation expense, which we call like a paper write-off, if you will, to offset your cash flow from a tax perspective. So you're hopefully not paying any taxes on that cash flow right now. But when you invest in a stock, you don't get to write off the cost of your stock over time. You only get to write off the cost of the stock when you sell it down the road. So I think that's a big picture, 30,000 foot level, big difference between, rental real estate, with that advantage, I think, from a tax perspective.
That's great.
Yeah, Matt, I really like that you brought that up, because one of the first things that I was told when I started getting into rental real estate is that there's some kind of accounting magic called depreciation, even though the property is appreciating in value. Like, depreciation doesn't mean that the property is losing value, right? Even when the property is gaining in value, you can depreciate it. Can you walk us through that a little bit more, and if that's avoiding taxes or delaying taxes and what all that means?
Yeah, I mean, essentially, it's kind of like a loophole the IRS is giving you, where, from a tax perspective, the assumption is that your property is decreasing in value because of the normal wear and tear, right? So you pay $500,000 for a property. Let's say 80% of it's building and 20% of it's land. So the 80% in that example, 400 grand, they allow you to take a depreciation deduction, spread out over 27 and a half years or 39 years. So essentially, you're kind of writing off a portion of the cost of the building every year, because it's being used and, theoretically being, worn down. But, to your point, at the same time, it obviously could appreciate by $300,000, while you're still taking a write-off for it.
The other thing I really like about depreciation is that the calculation is actually based on the purchase price of a rental property. and not necessarily related to the down payment of a property, which a lot of people think sometimes. So, in that example, if someone bought a building for $100,000, even if they only put $10,000 or $20,000 as a down payment, the depreciation calculation is actually based on that $100,000 building purchase price. And so, and effectively, you're able to take a tax benefit today on borrowed money as well, right? So writing off money that the bank has effectively, bank's outlay currently.
And you mentioned both 27 and a half years, 39 years. It sounds like there's some nuance to that. And I've heard of accelerated depreciation and other things as well. Can you walk us through some of those numbers as well and how that all factors in?
Yeah, I mean, the 27 and a half years is just the light, we call it the useful life or whatever. It's a depreciation life for a residential rental property. So, something where somebody's living in, single family house, duplex, fourplex, apartment building, versus 39 is what the depreciation period you get for a commercial property, which could be medical building, office, strip mall,
shopping center,
stuff like that. That's the general way of how you depreciate a building. But yeah, to your point, I mean, there's other ways that you can, what we kind of call like supercharging it, right? Where you can take some parts of those and maybe depreciate over a quicker time period, like 5 years or 7 or 15 years. The benefit of that is that you're writing it off sooner than later, right? So we're getting more deductions now, reducing our income, reducing our taxes now, hopefully using that tax savings to reinvest and go buy more income producing assets. That would be the idea.
And then for the supercharging, in order to capture all that, what kind of information is needed or what kind of things should an investor be thinking about in order to make sure that they're collecting all the information that a CPA would need to guide through that?
Yeah, that's a great question. So there's actually two components to that. The first part is what we call cost segregation. And that's basically, for the investor, you're working with your CPA, you're working with the cost segregation firm. And what they do is they break out the components of a building. So whereas earlier, if we use residential rental as an example, where Matt said, okay, well, if we have a residential property, we're going to depreciate the building over 27 and a half years, right? So if it's a $100,000 building, maybe we're writing off about $3,600 per year. Now, working with a cost segregation firm and the CPA, what they do is they can break out the components of the building. So instead of just saying, here, I bought a $100,000 building, it's the cost segregation from going into the building or getting the plans and the drawings for it and breaking out what makes up that $100,000 building. Right. So the result could be, well, of that 100,000, maybe 30,000 was for flooring, 15,000 was drywall, 10,000 for cabinets. And those different categories that we just named, a lot of them have different tax depreciation lives. And so a lot of those other ones might, instead of being written off over 27 and a half years, they might be written off over 5 years or 7 years. And right now we have an even added benefit, which is called bonus depreciation. So a lot of the assets that are within these shorter lives, you can actually write them off completely in the first year under bonus depreciation. And, the result's going to differ from property to property, right? But as an example, if we said, okay, we had a $100,000 building, maybe normal depreciation could be like $3,600 a year. With the cost segregation, industry average, we sometimes see the write-off in the first year to be anywhere from $15,000 to even $30,000. And so you can see kind of a big difference between those ranges. So, if you're someone that's in the 40% tax bracket, right, that's saving 40 cents on the dollar, right? If you can write a 15,000 write-off or a 30,000 write-off. So that's where, the depreciation and the bonus depreciation and cost segregation can be highly beneficial. So for that part of it, there's not really too much the investor actually needs to do because the cost segregation is just, it's done by a specific cost segregation company. All you really need is to provide them with the, closing disclosure, the appraisals, and a couple other items. There's another way to accelerate write-offs or depreciation on improvements that the investor is making. And so those would be like after you bought the property, if you are rehabbing it, putting in a pool, redoing the flooring, that's where a little bit of the work might come in from the investor's perspective.
Yeah. And I mean, with any of those, with the improvement side, the cost segregation, obviously this is not a do-it-yourself thing, but the same as getting your information ready for your CPA at cost seg. with improvements on the improvement side, what we tell clients is just keep as detailed list as possible as the work that you're doing on the property. And then at tax time, you provide that to us or your CPA. And then what they can do is they can analyze that to see, yeah, okay, what are some of the exceptions where we don't have to depreciate the entire remodel over 27 and a half years, but there's certain things that we can either expense right away, or maybe we have to depreciate over 15 years, but then maybe we get to take bonus on it, that kind of thing. So it's just kind of making sure you've got your documents in place and, that you're keeping good records, obviously.
Yeah. And I think the key thing too for, our audience is it's not your job to become a CPA and learn, how do you break out a building or how many years is the, cabinet versus flooring. Really, your only task is to make sure that when you're doing improvements that you have a fairly good listing of how much you're spending on what, 30,000 for cabinets, 20,000 for flooring. And that's really your role. And then your CPA will be able to help you in maximizing that write-off based on your situation.
Yeah, a couple of things you said there that I really like is one, that this is not a DIY thing. This does sound pretty complicated, but it also sounds pretty achievable if, as an investor, all I need to do is make sure that I'm keeping track of what's spent on what, those receipts, and that those receipts are relatively itemized. So it's not just like contractor gives me a $20,000 bill for a bunch of work, but that's kind of divided out there or something like that.
Yeah, exactly.
And our audience should be pretty familiar with documentation, right? If you didn't document it, you didn't do it. So it translates well from pharmacy over to real estate in this case. So one of the other things that kind of always comes up at this point too is, okay, well, there's depreciation. What other magic can I work with write-offs and things to get away with? And I feel like it quickly devolves into like, well, I heard you can do this. I heard you can write off this, and I'm sure it'll be fine. Are there things that, people think are legitimate, but actually aren't, or things that you advise your clients like, hey, this is important. We need to follow it this direction so that you don't get audited? Are there examples that come up like that you can think of?
Gosh, well, there's so many. What one person can write off could be very different from what another investor could write off, right? And maybe the two people both might be in pharmacy as a daytime career, but also doing real estate.
Yeah, you hit the nail on the head. The old, well, I talked to my neighbor and he said he writes off this.
Right.
Yeah.
Exactly.
Yeah, it's going to be very different, person to person and also transaction to transaction. But I think a good practice for any investor to get into is to make sure that they always have taxes in the back of their mind. And what I mean by, I don't mean like walking around thinking or talking taxes. I just mean that when you're spending money on things, throughout the day, throughout the week, always kind of have a little voice in the back of your mind asking, is this something that is ordinary and necessary for my real estate business? And the reason that this question is important is because in order for you to write off anything against real estate income, it has to be what we consider a business expense. And something I mentioned earlier, business expense doesn't necessarily mean it's paid from an LLC or a corporation. It simply means that the expense was ordinary and necessary in order to run your real estate investment activities. And so, examples might be if I'm driving over to Home Depot to get some supplies, is it reasonable that this is a business mile? Well, certainly, right? Or if you're going to Costco when you have to buy stamps and supplies for the office, is it reasonable that these are things I would use for real estate? If the answer is yes, what you should do is make sure you have a copy of the receipt. Talking about documentation, whether it's the actual receipt or take a picture of it, but make sure you have a documentation of it, that it's being tracked. And then at tax time, when you meet with your CPA, make sure you are providing that to them. Because I like what you said, if you didn't document, it didn't really happen, right? And that's a big problem too for people when it comes to taxes, because we're not filing our taxes until next April, and by then, odds are you would have forgotten what you spent money on, today or yesterday or a week ago. So it's important to kind of create a system so that you can track all of your expenses.
That makes a lot of sense. I think the one I always think about when I think about this example is people that take a vacation somewhere and they say, "Oh, it's a real estate vacation. I'm going to look at properties," and they try to write off the entire vacation, even though they spent a week and a half on the beach and an afternoon looking at one house. And it's like you said, is it ordinary and expected to be with that business expense? And obviously not in that case.
Yeah. And, for vacation type of, or, just travel in general, one of the key things strategically is to make sure that you have predetermined business activities. And this is something that, that we've talked about previously in our book is it's one thing to say, okay, I'm in Florida for vacation. I happen to stop by and look at some real estate. Well, then you can't really write off the flight or the hotel because you were really there on vacation. You just happened to do some real estate. Now, on the other hand, if before you booked your trip, you have a lot of predetermined, pre-scheduled activities where you're meeting with local realtors and brokers and, loan lenders, maybe local real estate clubs or events, it's perfectly fine to have a little bit of personal pleasure time where IRS doesn't want you to have to work 24/7 every day. But the key is to be able to show that the main purpose and the reason you were going there was for real estate. That helps you to maximize your write-off on that trip. Now, it may or may not be 100%, but it would still be a lot better than this other notion of, hey, I was there and I sort of happened to run into some real estate things.
That's a great tip.
Along with that, we're seeing in this market all kinds of craziness with values going up and people starting to think about selling. And one of the things that I keep hearing and seeing is people talking about this 1031 exchange when they're going to sell a property that's appreciated a lot in value. They have a big gain and they're worried about the tax consequences of selling a house that has a big gain. So I wonder if you could talk for a minute about what are those consequences of selling a house that has a big gain and how does a 1031 exchange fit into that?
When a taxpayer goes and sells an investment property down the road, they're going to pay taxes on any quote unquote gain they have for tax purposes. Now, how we measure gain is really sales price minus selling costs, and then it's minus your tax basis in the property. And so this goes kind of go back to what we were talking about earlier. Tax basis is the way we look at tax basis is your original cost minus the depreciation expense you got to take over the years. So you've gotten the benefit of some of that costs that you paid for the property before, so it's going to kind of come back as additional income on the back end. So yeah, when you sell it, you're going to have capital gains income usually. If you're selling it over, if you held the property more than a year, that could be anywhere from 15 to 20% for the IRS, sometimes 25% on the depreciation recapture piece. And then you got state income taxes depending on what state you live in, obviously. So now the great thing is if people are making if they're ordinary income, their wages and everything else, and they're a high tax bracket paying 32, 35, 37%. The nice thing is that right now under current law, the capital gains from sale of an investment property generally isn't going to be taxed at those higher rates. You're getting some sort of preferential rate on the federal side. Kind of fast forward where that 1031 exchange comes into play that you're asking about is when someone's got a large enough gain and large enough expected taxes that they're saying, hey, I don't really want to pay taxes right now. I'm going to sell this property. I'm planning to reinvest it into more rental real estate anyway. Why don't I do a 1031 tax deferred exchange? Essentially what they're doing is they're following a bunch of rules, working with the right people to sell existing property and buy replacement properties. And if they meet all the rules, then they don't have to pay taxes right now on the gain that they should have been paying taxes on. So it essentially defers that taxes, kicks it down the road.
Perfect. And then how is that different from, I keep hearing about this 2 and 5 rule of if you live in a house for a while, you get to avoid that entirely. Does that fit in there at all?
That is what that's referring to is with respect to people's primary residences. So if somebody sells their primary home and they're expecting gain on sale, if they've owned and lived in the property for 2 of the previous 5 years, they can, a single person can sell it and have the first $250,000 of gain be tax-free. Married couple can have up to $500,000 of tax-free income. But that's on your primary residence where the 1031 exchange doesn't apply to primary residence. It applies to kind of, essentially investment real estate, like rental real estate.
And something interesting too is we actually have clients who've used both in conjunction with each other. Meaning, there's a property that they lived in it 2 out of the last 5 years.
Someone's going to be driving their car right now and just crash to the side of the road. Mine was blown, right?
And then that home is turned into a rental property. And what could be done is when they actually sell that property, they can use the capital gain exclusion. And if their gain is beyond 250 or 500,000, they can actually do a 1031 exchange on the remainder. So they lock in part of whatever should be tax free, and then the rest they could still defer it via the 1031 exchange. So that's an interesting one that we sometimes see or have investors work with.
Again, not a do-it-yourself thing.
No doubt.
No, that sounds complicated, but it also sounds not uncommon. I know we're hearing from a lot of our listeners where they buy a house, live in it for a while, move out, and keep their old house, turn that into a rental. And so it sounds like there may be some advantage of either keeping that only for a shorter period of time and then selling to avoid some taxes, or sounds like leveraging the 1031 exchange is another option as well if they keep it as a longer period of time as a rental.
Yeah, definitely. I mean, that's where kind of, looking at the numbers, right? Looking at the numbers of what's my gain going to be if I sell it now? What's it going to be in 2 years? Instead, sell it now and replace it with something else. What's my appreciation cash flow going to be on that? That's the kind of numbers you got to look at.
I feel like the theme of this episode is becoming plan ahead, right? These are not decisions you make and then go back to your CPA and say, hey, I did this thing. Can you help me make sure that it's not going to tax me terribly? Like, you want to plan this alongside your CPA, like in lockstep with them, because all the things you're saying, it takes that prep work, it takes planning. I mean, that's the thing that I'm getting from this so far.
Yeah. And it's so great that was what you picked up in this conversation, because I don't think a lot of people ever mention that, or just, even on other podcasts that we go to. But yes, you're exactly right. A lot of people will come to us and say, hey, can you do my tax returns for last year? And the reality is, whether you're working with us or, another firm, the results are probably going to be very similar when it comes to filing last year's tax return, because all the transactions have already occurred, right? I mean, you already did what you did. You either, tracked your expenses or you didn't. You either did a 1031 or you didn't. And so there's very few things that could be done. But really, to be effective at saving taxes, it is really all about proactive tax planning. So really, when we're looking at going forward, what are the transactions you have? Because those are ones where you could still make decisions, and there's different, options A, B, and C might result in a lot of tax, a little tax, or zero tax, right? And that's the important part. What I always tell people is it's not as important who's filing your tax returns, but more important who's helping you with the planning during the year.
That's a great tip.
And, unfortunately, I think what we've seen is that a lot of CPAs or just tax advisors are really focused on the tax preparation side. It is a necessity. We all have to file taxes. And so that takes up a lot of time for people. And so it is really important, whether it's your existing CPA, you're looking for a new CPA, to try to find out what is it that they do when it comes to tax planning. What is the process? How often are you meeting? Those are the kind of questions that you'll want to know, because really that's, like I said, that's the main piece to success, or the key to success is making sure you're doing things ahead of time. And, I think a lot of investors are scared when it comes to taxes, or just people in general are scared when it comes to taxes. It sounds very complicated. It's never really pleasant. Nobody likes to track expenses and talk to your CPA and keep receipts. Nobody likes that. But I think it is, nonetheless important to make sure you have a system set up so that a lot of these could be automated. And the more time that you invest into learning about some of these things, the better you will be. And the goal is not for the investor to become a CPA and know all of the nitty gritties, but at least have enough of a knowledge to, have a good conversation with your CPA and know what are the right questions to ask.
Yeah, that's huge, especially knowing those questions and saying, hey, and working with somebody that has the experience to be able to kind of guide people to that. That's super important. So how does that change with legal entity formation? I don't want to touch on the legal side of it, right? The legal protection side of it. I know that's a whole different episode, but from a tax standpoint, like, how does that change if I've got an LLC that's actually running this, or an S Corp, for example, that's running this?
Yeah, that's a great question. And the answer, again, is going to differ from taxpayer to taxpayer.
Sure.
But the general background is, if you are a landlord, right, meaning you're just someone investing in rental real estate, whether it's single family, commercial property, there's generally no tax difference whether you own your properties in your personal name or in an entity like an LLC or a partnership. And by no difference, what I mean is you can have the same write-offs either way, right? Write-offs like your car or your home office, or maybe you're shifting some income to your kids because they're helping you out with your real estate. So, or your business travel, right, to look for properties. So all of these are tax deductible regardless of whether you have an entity or not. The key is that you're in the business of rental real estate investing. Okay, so from that perspective, the only reason to have an LLC is for asset protection purposes. And the questions of where should I form it? Is it Nevada? Is it Wyoming, or my home state? That answer is best answered by your asset protection attorney, because even amongst attorneys, they have different differences of opinion in terms of where to form. So that makes it very simple on the tax side when it comes to rental real estate. The complexity comes in a little bit more when, if you have an investor who's doing more active real estate, like they're flipping or wholesaling, or syndicating a deal where they're pulling investors together. In those types of income is very different than rental income. Sometimes it could make sense to earn that type of income in a corporation, whether C Corp or S Corporation, because that helps the investor to reduce self-employment taxes that we pay into Medicare and Social Security and things like that. So the distinction would be if you're an investor who's doing just more of the rental side, or you're an investor who's on the active real estate side of it.
That's great. That's good to know.
That seems like just one more thing of some proactive planning that goes into this, not just this like, whoops, I did a thing. Can you help me figure this out? But no, like, I want to go do this. How do I do this properly so that I don't get in trouble or have a huge tax bill later? I know that was one of the major things that I saw from your book and in the stories that you had in there. It's just these like, oh my gosh, I need to make sure that I talk with someone before I go and do these things. So.
Yeah. And you're exactly right. It's funny because, as much as we kind of, talk about it and try to educate people and, wrote about it in the book, we're still seeing this, kind of similar errors. And in fact, right before our show today, I was talking to a new client, looking at their structure, and it was, just from 2 years ago, but I don't know what the reason was, but their old CPA had them in the wrong type of entity. And, one of the problems is when you do something incorrectly, it's never an easy or clean way to fix it. So in this example, the good thing is, we can fix it. It's something that could be fixed, but not without headache and cost and potential IRS exposure. And that's why it's important to make sure you're set up correctly from the beginning, so you don't have this headache in trying to unwind something or to clean up something later on.
Yeah, I like what you said too about making sure that you've always got taxes in the back of your mind too, because if you're proactive in this, you're thinking about this as you are going through the year and you're getting property manager statements or receipts from contractors or any other expenses, hopefully you're documenting and keeping those receipts so that at tax time, it's not a nightmare in January of where did I put that? Where did I put that? Where's that box? Where's that? So pharmacists are super detail oriented and used to keeping records, but anything else that you'd recommend as far as keeping things and trying to track the books?
Yeah, I think that one of the questions we get all the time is what system should I use? There's QuickBooks or Stessa or just property management software. And what we typically tell people is it's not important what the system is for me as a CPA. What's important is what is the system that works for you as the investor. And the reason for that is because if you're someone who is great with software, then something like QuickBooks is perfect, right? It helps you automate a lot of things and it can help simplify things. But on the other hand, if you're someone who is not great with software, you really don't like to learn software, then QuickBooks is not the best for you, because what's going to happen is if, you buy QuickBooks, you'll probably just put it on the shelf and really, try not to look at it. And then by, like you said, next January, kind of have a panic attack because nothing was tracked. And so it's really important, I think, for each investor to figure out what's the best way that they like to use. They like to systematize, whether it's Excel or QuickBooks or even a notebook. And the reason that's important is because when you find a system or you even create a system that works for you, odds are you're going to use it more frequently. And that's our goal. Our goal is that you have a system where you are using frequently throughout the year, because that's the only way you can ensure that nothing is lost and that you're capturing everything that could provide a tax benefit.
That's a great tip. And it's something that I finally started adhering to better this year with my own real estate business was actually tracking my mileage with an app. I used to literally come down and like spreadsheet it, and I would forget half the time. I'd see a client somewhere and be like, how far was that? And my CPA at the end of the year was like, Nate, this is awful. I can't track any of this stuff. So I finally switched over to an app this year, and it's made it so much easier. I just hop in the car, hit the button, and it's recording it. So you're right. Finding your own system feels like the way to go. So the other thing that I wanted to bring up too, that David, you actually mentioned this about contractors. And I learned this in the past year, and I'd love kind of your advice or oversight on this. When you have a contractor, let's say you're having a contractor do a pretty large job throughout the year, talk to me about issuing them, 1099 or something like that, because that's something that I don't think I hear a lot of people talking about, but it's come up this year, at least for me in the past, and it seems pretty important.
Yeah, it's definitely important because it's something that the IRS, requires people to do in certain circumstances. Now, when we're talking about issuing 1099s to people, keep in mind that this has got to be related to your business, right? So if someone, if you're remodeling your primary residence, you don't have to issue a 1099 to your contractor, obviously. Mm-hmm. But, if you got an investment property or you've got your own business and someone's providing services to your business, one threshold is usually you have to pay the person over $600 for the year before it becomes an issue. Mm-hmm. The other thing is usually you only have to issue the 1099 if you're paying them via cash, or a check. Mm-hmm. So if you're paying them like a credit card or Venmo, PayPal, Zelle, one of those other things, typically you don't have to issue them a 1099. And the reason is because those companies, it's on them now to issue the 1099 to the recipient.
Oh, wow.
So kind of if you pay them through one of those platforms, it takes the burden off of you. And then the other thing is if they are taxed as a C corporation or an S corporation, regardless of how much you pay them and whether you pay them with a check or cash, you aren't required to issue a 1099 to them. Now, you're not going to know that unless you give them a W-9 when they start doing work from you. A W-9 is kind of it's an IRS form. You can download it from the IRS website. Mm-hmm. And basically, you give it to the service provider. They fill it out with their name, address, ID number, and then the most important one on there is they check a box that says, "How am I taxed?" Mm-hmm. They sign that. They give it to you. That's your document. You keep that in your file. It doesn't need to go anywhere. But you basically use that paper at the end of the year to say, okay, I paid them more than $600, but I look at this form, they're an S corp, so I don't need to issue a 1099 to them. Or they are, a partnership or sole prop. Well, then maybe I do need to issue a 1099 to them. So that's kind of the thought process and kind of things to think through.
And is that something your CPA can help you with, or is that something you need to do on your own?
Oh yeah, for sure. I mean, it's kind of we just recommend to clients, the first and foremost, most important thing is to recommendations, get them to, give you those W-9s. Now, a lot of times that's obviously a lot easier when you start the project versus, hey, it's February and I'm trying to get a W-9 from a contractor. They may not be willing to sign it at that point, right? But yeah, get the W-9s in your files and then, you can provide the information with the W-9 and, how much you paid somebody and how you paid them to your CPA. They could probably quickly look through that list and determine, okay, of these, 10 people on your list, you got to issue a 1099 to 4 of them or something like that,
Yeah, that was definitely a tip I learned early on or learned the hard way early on was that don't ask for the W-9 like 6 months after they've done the job because they don't care. They don't want to give it to you then. Ask them before they start the work. That way you don't miss it.
Yeah.
Yeah, there's a lot of tracking and remembering in some of this stuff too. As we're talking, it's definitely starting to feel like a lot. I know for me, I was really good at forgetting a lot of these things without some kind of reminders and systems, and thinking back to some of the, I'm using air quotes, like bookkeeping that I used to do that as I learned more about bookkeeping wasn't even close. Like I probably was terribly annoying to my CPA and the reports and things that I would put together. So can you tell me a little bit about looking for a bookkeeper or someone to help keep track of all this and help keep things moving throughout the year so that January, February isn't a nightmare, and even just preparing documents for a CPA?
Yeah, I think, so like for our clients, for example, they have a checklist every year. And so it kind of is a way for them to know what are some of the things that we need at tax time, and also how helps them to gauge like during the year too, right? What are some of the things I need to make sure I'm saving, closing disclosures, refinance, closing documents. Obviously, income and expenses from each rental property is a big one. The decision of whether a particular investor decides to do the bookkeeping themselves versus outsourcing it and hiring a bookkeeper, I think that's going to differ from person to person, right? One of the things to look at is, whether it's something that you enjoy doing and you're good at. If so, then it's perfectly fine to do it yourself. But, we also have clients who are just not good at it, or it's just not something that they enjoy doing or want to be doing.
Or it's not, they're not the highest and best use of their time, and they
yes.
recognize that.
Yeah, exactly. That's one of the key things is that the best use of your time? What's the hourly rate that you would otherwise be making if you weren't doing this type of a task? And figure out, okay, does it make sense for me to hire someone to actually do the bookkeeping?
Yeah, and I think pharmacists are definitely used to all of the pharmacy work being a team sport and having other people around them. So I think a bookkeeper could be a logical person to seek out. I think another one, as we're talking here, and kind of one of our last of our main questions here is, it seems like there's only so far that you can go with tax software yourself without any of the knowledge behind it. And so can you help us understand, at what point does a pharmacist need to think about, I really need to talk with a CPA as far as both tax preparation and tax strategy? How does someone make that leap?
I think that also will somewhat depend on the investor themselves. I
He's gonna
have
start calling us lawyers if we keep saying that answer.
Yeah. I have a client, a planning client who is a physician, and he did his own tax return for many years. We just helped him review it this year. He had, I don't know, a dozen properties, did cost segregation, just all kinds of very complex stuff. And the return was, fairly good condition. I was somewhat surprised.
Wow.
But we have other people who just kind of don't really know even where to begin, right? It's like it's easy when you have a W-2 and a primary home to do something like TurboTax. But once you get into rental real estate, there's depreciation, there's a lot more things, and where do you actually put that in the software? That can become a hurdle. But to be fair, the softwares are good, right? Whether it's TurboTax or H&R Block, generally the software are able to perform the right calculations. We don't ever see errors there. The errors we see are user errors. When they ask you a question, are you understanding that question correctly? And this is where we kind of see mistakes, where sometimes we might review a tax return where there's no depreciation, right? And the investor's like, hey, I did enter the information, but maybe it was entered in the wrong way or in the wrong format, so it didn't really take. Or sometimes we'll see a rental property that's reported as a sole proprietor, Schedule C, like an online marketing business or something. So those are the kind of things where a user error might come into play. So I think a lot of that depends on the confidence level or the competency level too of that particular investor in the preparation side. But I think it's always good to talk with someone for proactive tax planning, unless you are a pharmacist who's also very well versed in real estate for some reason. Otherwise, it's always a good idea to work with someone on the planning side, because on the planning side, there are changes to what you're doing on the investment side of things. Maybe you have long-term rentals, but getting into the short-term rental space, or you're renting out to traveling nurses or whatnot. And there's different tax rules for those. And then add on top of that, there's always tax changes, right? And we saw that a lot last year with COVID and the CARES Act, probably more coming down the pipeline as well with upcoming tax changes. And so it's a lot for a non-CPA to kind of be aware of all those things. And that's where having someone help with planning.
Heck, it's a lot for a CPA to be aware of those things.
That's true.
Yeah, I bailed immediately. As soon as I had my first rental property that year, I was like, no, I'm not doing this anymore. This is crazy. TurboTax, see you later.
Oh, same here. One property was all it took for me.
It's just not in my class of things I want to figure out. I know you guys are much better at it than I am.
Yeah.
So. Well, guys, this has been awesome. I want to make sure we flip over to our final infusion questions. These are 3 questions we ask all of our guests in some capacity. And the very first one is, what is one tangible strategy to make working in your business not distract from working on your business?
That's a good one, because I think that's one that we struggle a lot with ourselves as well, because, we have our CPA practice, we have real estate, and just personal stuff that comes up all the time. So what we do, we just block it out on the calendar. We have what we call A time. A just meaning, the most priority. And that's the time where, when the time comes, that's what we do. There's no client meetings that are booked over it. It's basically the time that we focus on working on the business and just, more big picture things. How do we systematize? How do we grow? What's the goals? But yeah, I think for us, we have to calendar that in. Mm-hmm. Otherwise, it gets lost in the translation, or on a to-do list that's never done.
I think from a kind of a number side of answering that question, that's a great time to look at financial statements. So not waiting until 12 months later to look at your year-to-date financials. You can look at them throughout the year as you have this time set aside and say, hey, you know what, this rental is not performing as well as I thought it was, or I'm doing fix and flips and I sold that property and I only made $5,000, but I thought I made $25,000. That's the kind of stuff that can tell you that sooner than later, so you can make tweaks in your business that you can change how you're doing things to hopefully improve going forward.
Great tip.
Yeah, and that proactive strategy is just so important, because it's so easy to get in the groove of busy life and just keep doing. But learning those things can help make those tweaks in the business that can be huge. What's one resource that's been most helpful to you in your real estate or business journey, whether that's a book, podcast, person, author, website, whatever that would be?
Well, I think on the real estate side, Bigger Pockets obviously is something that has been super helpful for us, both from the perspective of, an investor, And also just on the, on the CPA practice as well. It's such a great way for us to connect with investors, not just locally, but also outside of the US, and just learning from other investors who are doing slightly different things and kind of what's working, what's not working. I think that's really been helpful. I think a non-business one, we attended an event called Maui Mastermind many years ago. It was one that kind of helps business owners with how to take your business to the next level. I think that's a program that really helped us earlier on in our career to figure out how to grow our tax practice in the right way.
Yeah, I think another one that comes to my mind is, and this can apply to anybody, is in any business, is make use of your network and your colleagues. So when we started our business, we had a lot of colleagues that had already taken that path before us, right? And so it's really been really helpful to kind of pick their brains over time, sit down with them a couple times a year, and figure out what's working in their business. Well, how do they deal with this? How do they deal with that? We're having this issue or something like that, where I think that gets overlooked a lot, where people, don't reach out and don't utilize it as much as they could.
Yeah, that's a great tip. And it's exactly why we have the YFP Real Estate Investing Facebook group. So if you've not had a chance to check that out, there's an awesome community of other pharmacists talking about real estate, talking about pharmacy. It's a place to go. So a really good point, Matt, because that community can be, and the network can be so hugely important. So our last question then is, what's one piece of advice that you'd give to someone that's contemplating a start in real estate investing? And again, I know you guys are coming at this from two perspectives, but even if you were to look back at when you first bought your first rental property, what's one piece of advice you give someone that's contemplating that start?
My piece of advice is to do it.
Yeah.
It's don't get caught up in the numbers. Don't, what do they call it? The paralysis analysis, or analysis paralysis or something,
Yeah.
That's where a nerd like myself gets sucked into, and some, maybe even a detail oriented pharmacist might get sucked into.
Exactly.
Yeah, and I think similar thing of the just do it. It's one of the issues sometimes I see with newer investors is kind of the shiny object syndrome, where there's so much education out there now, where one day you're learning about rental real estate, next day you're kind of learning about mobile home investing or short-term rentals, and I think sooner rather than later make that decision. What's the product you're investing in, what's the market area, then you'll be able to kind of really dive into that and kind of faster start, versus kind of jumping from opportunity to opportunity and never really finalizing kind of what the first step is. So I think that's also important. And the first deal doesn't have to be a home run deal. A lot of that is for learning experience. I mean, it should be a decent deal, of course, but I think that's where we see sometimes when investor, year after year, still in that startup phase, which is what you're trying to avoid.
Yep.
No, I love that. Getting started and diving right in is something that, eventually at some point we all have to get past that analysis paralysis and do it. And I think one of the things that I know I've taken from your book and just talking with you today is that there's people out there that can help you with those questions along the way that you have to make sure that you're doing it right, doing it safely. And so those resources are available. So speaking of those resources, where can people find you, and how else can they plug into what you've been able to do to help other real estate investors?
The best place to find us, I'll go with that first, is on our website. That's www.keystonecpa.com. We have a lot of great resources on there, recent podcasts that we're always posting the most latest information. We also have a free downloadable ebook. It's called 5 Cash Flow Strategies for Real Estate Investors. So if you're wanting to learn more about how do I, pay my kids for a tax write-off, or what are some considerations I should think about before I form my legal entities? So a little bit more in depth on, some of the things we covered today. Definitely check those out. And again, you can find those on our website at www.keystonecpa.com. But yeah, I think I love what you said about, just understanding that you don't have to be an expert in all things real estate, legal, tax, because there are great people around who can help you with that. And that's actually our tagline for our firm is, tax planning made easy, because we want people to understand, taxes are hard, but your role as an investor is easy as long as you know what are those simple things you have to be doing during the year.
Great advice, guys. I sincerely appreciate you both being on the show today. It's been absolutely incredible. And I think you're giving a lot of great tips for our audience to make sure that they can plan ahead so they don't have to panic come April. So Really appreciate all your time and wisdom, and we'll make sure to put all those details in the show notes so people can track you down. And again, just thanks for being here.
Yeah, thanks so much, guys. I appreciate it. It was fun.
Thank you.
Thank you.
Thanks so much for joining us for the YFP Real Estate Investing Podcast. If you liked what you heard on today's episode, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone who'd make a good guest for the show, or want to connect with Nate and David, head on over to yfprealestate.com or join the growing YFP Real Estate Investing Facebook group. See you next time.